So this talk is called Applications of AI for Quantitative Finance at Thomson Reuters. My name is Joe Rothermich. I'm a Senior Director of Quantitative Finance and Data Science at Thomson Reuters Labs, the Applied Innovation Group. And I head up the San Francisco lab out here to do innovation on new products, new ideas. And in San Francisco, we kind of specialize on the quant finance side of things. And we're the group that came out with StarMine models, which are used by institutional investors. So I'm going to talk a little bit about who we are and why we're dealing with data and AI, our views on AI and finance, and some of the trends that we're seeing, and some of the things that make finance a difficult area to work with for modeling in general and with AI, and then talk about some of our projects that we've worked on. So Thomson Reuters is a pretty big company. It's got legal, tax and accounting, Reuters News, financial data, and risk data. So I'm on the finance and risk side, so I'll talk about stuff applying to that. We're about to split off a month from now. The whole company is going to divide in half, and the finance and risk business is getting acquired or taken private by Blackstone. So that's going to be a big change for us. The new company is called Refinitiv, and it has allusions to the Reuters and the finance history in our company. We sell mostly to business, to big institutional investors and so on. So fortunately, I don't have to try to sell anything to most of the people in this crowd. I just want to share what we're doing and what we've learned. And we do have a lot of data. So I think this is why I'm there, and a lot of my colleagues that are data science-y are there, is that there's a lot of stuff to explore. And we have almost 6,000 people who for many years have been working on content and manually curating this data, which really creates a good set of gold data to train models on. So we have 5 labs around the world right now. I'm in San Francisco, but we've got New York, London, Singapore, Cape Town, all with the goal of kind of doing these iterative experiments with customers with our data and applying novel emerging technologies. This is a picture of the San Francisco lab skill set, but the other labs are kind of similar: data science, quant finance, programming, prototyping skills, UX, and design thinking. And so I'll talk a little bit about where we see AI in finance and what the history has been to a certain extent. And I'll start off with a little story that back in 2012, I was at a quant hedge fund at the time and doing a lot with machine learning in a systematic strategy. And I was helping to organize a conference for the Boston CFA Society. It was called Quants in the Clouds, and the idea was to talk about cloud strategies and using artificial intelligence or machine learning to build up investment strategies. And it was going to be a pretty good talk. I was talking, and Wes McKinney was going to be there, who wrote the Pandas package, and somebody from one of the bigger hedge funds in Boston, and so on. But sadly, the event was canceled due to lack of interest. I think it was just maybe a little bit too early. At the time, finance companies were very resistant of anything to do with the cloud, which kind of restrained what they could do from a technology perspective, but also just machine learning in general at that time was kind of thought to be this kind of scary beast that could create overfit black boxy models. So now jump forward 6 years, and in 2018, AI and finance is everywhere. I got these in the last couple days. They're all articles from the last couple weeks, and it's really taken off. And so to try to understand this better, we, as Thomson Reuters, commissioned Greenwich Associates to do some interviewing with different companies and try to understand their adoption of AI and data in general. And what we found is that a lot of companies are not yet using AI, but they are certainly intending to, and they see future use in the coming years. The biggest impact that our clients are seeing in the use of AI is not so much building predictive models or in creating rule-based systems for investing, but to instead kind of use it to help create more data. I mean, investing is an information game, and if you have a little bit of an information edge over other competitors, then that's where you can win. So I think that's where the emphasis is, at least right now, is really to try to use AI to help with the data problem. And part of that data problem is encapsulated in this whole idea of alternative data. So companies are really starting to get excited and are really doubling down on new data sets. And so alternative data can have a lot of different meanings, but I kind of see it as anything that doesn't come from traditional financial sources like price data, financial statements, and that kind of thing, you know, like fundamental data and so on. So this can be exhaust from companies, Internet of Things data, cell phone, and so on. And there's a lot of text as well that's kind of unmined for value. And so companies are really starting to explore this space. There's a lot of different sources. And I think a common denominator of a lot of this data is that it needs machine learning in order to make it usable. So structuring unstructured data, trying to figure out what companies are being talked about or how this thing links into the financial security that can be traded and so on. So I've already talked a little bit about the delays, you know, why people were afraid of AI in finance. It was about lack of trust in the algorithms. People were afraid of black box models and so on. Not trusting the cloud. I think that's changed a lot. You know, you see some regulatory issues. People were worried about IP, but I think they're starting to realize that a company that's built to manage this stuff securely might do it better than your own internal IT teams. And then data as well. It takes a lot to get your data into a format where you can then set it up for machine learning and do that at scale. And then I think we've also seen changes in expectations of what AI should and could do for finance and focusing on the right things. So finance has some unique challenges. The markets are inherently non-stationary. That's because they're driven by human investors that change their behaviors and evolving algorithms. There's a really limited set of data that you can use in your backtesting, especially if you trade on a monthly cycle or a daily cycle. There's not much data at all to look at. That's changing a little bit for people that are using tick history, but that's a different type of trading in a way. So point-in-time history is an issue. If somebody corrected the data in the past because they noticed an error, we don't want that in our backtest because that's not what we would have seen at the time. We want to see what was published. There's survivorship bias, which means that companies that have failed and gone out of business might be excluded entirely from a data set, which means that you're biasing your results. And the same thing with look-ahead bias, too. I mean, it's really easy for things to creep into historical data about the future. And non-quants often don't worry about that quite as much, I think. And so with all these things combined, it becomes really easy to overfit models and to create things that are going to find spurious patterns in the data. Meb Faber, who is a fund manager, put this on his Twitter feed, this picture, and somebody had made the comment that it reminds him of a Marshall McLuhan quote: "We look at the present through a rearview mirror, we march backwards into the future," which I thought was a good analogy for finance. So another issue is that mapping to companies is really hard. There are changing and evolving organizational hierarchies with mergers and acquisitions. Trying to figure out what brands belong to what companies is not always as obvious as it seems. There's symbologies all over the place, different standards. And what's worse is that they will take a ticker symbol from one company, and when that company changes or goes out of business, they'll give that ticker to a new company. So, that it becomes really hard to map things in a point-in-time standpoint. So once you're past all that and you start to build models, people are also worried about black boxes. And as I mentioned, the risk of overfitting is really dangerous in finance, and so people want to understand how a decision was made. There's certain sophisticated hedge funds that will trust the system completely, but others want to have model interpretability. As Edward Tufte says in his tweet here, that you can really trick yourself with statistical models, even like a transparent model, like a linear regression. if you do stepwise regression, it's really easy to convince yourself that the coefficients, the direction of the coefficients make sense. And then all of a sudden they start flipping when you change some variables, and then you start rationalizing again why they're in that direction. So when you move into more nonlinear models, that can even get more dangerous. So for a lot of people, the best approach to that is to start with the financial hypothesis and use the data to test that hypothesis, and don't just data mine to look for patterns. And then also, instead of trying to use AI to predict prices or to predict returns, you can use it to create new data that could be input into another model. And so there's this conception that AI means that the robots are just going to take the control of the whole process and run amok, and the humans are going to be out of the loop. And I think that's not how it's going to be, at least in the near term. I think that there's going to be this collaboration between humans and machines. And I think a good analogy is in generative art. I don't know if you're familiar with this, but it's becoming more popular, at least on my Twitter feed. Maybe I have selection bias. But it's basically the process of a computer generating, being part of the creative process and generating visual art, music, and now even text can all be generated from a computer. And there was this blog post last week. It was a really good article that said that we should abolish ideas that credit machines for making generative art and not the artists themselves. And the idea is that the artist is controlling how much randomness to give the automated process. They're controlling the constraints. They're controlling the direction that the whole process takes in the first place. And I think that's a powerful, thing that is very similar in the financial modeling process. You don't just let the computer data mine away and find any pattern that they want. You have to think about, your domain knowledge. You have to think about what you're bringing to the table and the knowledge that black swans exist and so on, and then guide the computer accordingly. So I think that through better expectations of what AI could and should do, more access to computational power, which we're seeing, every talk kind of mentions that's a driving force, and better data, getting that data into a format where you can actually do this kind of work. And I think companies are just desperate for new information sources, and they're starting to see from competitors success in using these type of techniques. So I think we are kind of getting towards an era of man and machine cooperation and making smarter machines, and those machines making smarter humans, and not that one replaces the other. And I think Paul Tudor Jones had a pretty good quote about this. He runs one of the larger hedge funds. He said, "No man is better than a machine, and no machine is better than a man with a machine." And I think it makes a pretty good point about the cooperation angle. So now I'll talk a little bit about some of the things we've done at Thomson Reuters, or where our focus is. I'll talk about what we're doing in alternative data, talk about the project called BOLD, which is Big Open Linked Data, and it's kind of around taking unstructured data or structured data, combining it into a knowledge graph, and then some models that we built to predict credit risk and M&A activity. So alternative data is a big area for us because it's a big area for our clients, and it's very exciting because there's all this kind of information coming out. Companies are realizing that the data that they collect in their non-financial businesses might be valuable to an investor, or just to people in general to understand what's happening in the economy. What are people doing? How are people behaving, and so on. There's a lot of value that can be pulled out of this data. The stereotypical example is in satellite imagery. People use satellite images to count the cars in parking lots, and then they can understand the number of customers going on a daily basis and try to predict the quarterly revenue numbers by looking at same-store sales metrics and so on. And there has been success with that. Now it's kind of the common thing for people to look at, but that was kind of an early story. Another area is in mobile phones. It's an area of very rich data in multiple dimensions. There's over 7 billion phones in the world right now, which is pretty incredible considering the world population. And as I'm sure this audience is pretty well aware that all of you have apps on your phone that are tracking every detail about you and your location and selling that off which is kind of a scary thing. And I think that we're very much at the beginning of that discussion around privacy and around ethics with data. But I think that there are some levels of aggregation that people will feel comfortable with to understand how economies work and how people move and affect traffic and can affect city planning and so on. That doesn't infringe on privacy, but that's to be seen, because I'm a little bit of a paranoid myself. So some of the stuff we've done with this kind of data is to track planting progress with mobile phone activity. So we're looking at farmers in the fields, trying to understand how much they're actually doing work-wise, and at what point are the crops going to be producing, and how much are they investing, and so on, and this affects commodity prices. This was kind of an interesting thing, because we realized that we had a couple different providers for this type of data, and those providers were giving us totally different results. And we realized that some farmers might not be using Snapchat, or they might not be using some MyFitnessPal or whatever. So it depends on what providers are actually doing, and there's a lot of selection bias there. Another example is in using satellite images not to track cars, but to track barges at ports and to try to understand commodity flows and import and export. And then text data is a big area for us. They say that 80% of the data within enterprises is unstructured. And it's probably true within Thomson Reuters, but I think it's true among the data that we're starting to look at externally as well. And so I'll talk about some of the examples of how we're dealing with text. And part of that is this big open link data project that we have, where we look at identifiers and tagging of text, and then that feeds into a knowledge graph. So starting out is this PermID concept, which was initially an internal project. 10 years ago, we realized that we had all these different databases. We grew through acquisition, so all these different products didn't talk to each other, and there was originally no need to join those together. And then I think somebody woke up and realized there's value in combining all that data. And so we spent a lot of time internally just creating common identifiers, trying to map the data together, allowing the databases to communicate through this common identifier. And then a couple years ago, in 2015, I think, we released that under a Creative Commons license using direction from the Open Data Institute, and we used kind of semantic web type of methods to expose this data in a kind of free and accessible way. This is what it looks like if you go to a website. Each URI of a company, and it can be a company or a security or a person or an event or country and so on. Each one maps to a page that has metadata and reference data about that company. And this is all on permid.org. And the idea isn't to create one more standard. It's more to allow people to work with our data better, but also just kind of creating less friction in general about working with all these different data sets. So once we have the PermID in place, we can use that in conjunction with some tools to tag unstructured data. So we have this thing called Thomson Reuters Intelligent Tagging. It was originally a startup out of Israel called Calais that we acquired maybe 10 years ago. And the idea is that you take unstructured content and extract or label companies, people, events, relationships, topics, and locations, and put that into a structured format. So then it can be combined into your own structured data and used in kind of a machine learning type of process. Here's an example of what that looks like. This is also on that permid.org website. There's some trial stuff that you can play with. But the idea is that you feed it in your unstructured content, which could be news or an analyst report, different types of data, and it pulls back references to the outside world. So a permid or references about what the data is in the document. And now, since you have this unstructured data tagged up and structured, you can combine it into a knowledge graph and then start to apply some graph-based analytics on it. We have some tools that we've built in-house to try to help us deal with that and to stitch in other data and so on. but it's hard to really extract value from a graph, and it becomes a big hairball, spaghetti ball pretty quickly. So a couple of the example projects where we've tried to do this to try to get value out of the graph are, one was a project we did, I think it was in our Singapore lab last year, where we ingested the Panama Papers and try to connect that to our people and company databases all through this knowledge graph, and try to understand how companies and people might be related to offshore activity. Maybe it's indirect, maybe it's direct, but try to create this kind of flow to create an offshore score that represents the risk of a company being associated with offshore activity. Another project we worked on, which was one that I directly worked on, was this story about taking a news story and trying to associate it to a portfolio that you might be investing in, to a set of companies. So the idea is that, yeah, you can tag a company that was mentioned in an article, but there might be a news article about an event, maybe a natural disaster that happens at a factory that is a supplier to a competitor. And maybe you would still want to know that as an investor. So it's really hard to traverse that graph and to understand how important the relevance is and to score that relevance accordingly. And maybe you want to tweak the parameters based on your use case. If you're a supply chain manager, or if you're a investor or a risk management compliance person, all those kind of weights and the importance that you put on different types of relationships are going to change. So now I'll talk about our text mining credit risk model. This is something we actually created back in 2011. We launched it as a part of our products with StarMine back in 2012. And this is what it looks like in our Icon desktop platform. The idea is that we have all these news stories and other text stories coming in, and we can score them and represent the associated risk of each of those documents. And then we combine that all together to create a probability of default and an applied credit risk, kind of like you would get from the rating agencies for that company. And then we can also put it in a percentile ranking of how risky that company is and how likely they are to default. So the model actually performs pretty well. The text part is a part of a bigger combined credit risk model that also takes in structural and market data and then financial statement data. But the text component is pretty interesting because it can beat the rating agencies because it's constantly scanning text, listening to CEO interviews or releases from companies or financial statements, and picking up on things that might be mentioned that might imply some kind of a credit problem. And we've seen that we've had pretty good success with this model over time. And the data that we're using to feed into this model is street events, company filings, Reuters news, and broker research. Each one of those things is scored on its own, creating a 1 to 100 rank, and then we combine those to create an overall probability of default and the implied rating, and that feeds into a higher level model as well. When we built this in 2011, it was pretty early on, at least in finance, to be doing things with Hadoop and massive amounts of text. And we also had the problem where we wanted to create a clear box, not a black box model, and wanted that model interpretability. So we used a bag of words approach, stemming the words, figuring out n-grams, and trying to understand how those words would be influential on predicting credit risk. And it was a pretty clear method, but we didn't evolve it much over time because a lot of our customers, once they test a quant model, they want that thing to behave the way that they're expecting, and they don't want it to evolve, which is something I think we're going to have to come to terms with as we continue to get more and more advancements in AI. But now it's 2018, and we're considering changing the model using deep learning. And we did some initial research on this already, and we found pretty good results. So one interesting thing about how we approached this wasn't to take the historical defaults, which are pretty rare, on a company by company basis, to give us more training data. We actually took the output of this other the old model, which is based more on classic methods, and use that to actually predict the probability of default as opposed to just predicting the credit events. And that gives a lot more data to work with. And surprisingly, it actually performed better than the model it was training from because it didn't get caught in the edge cases. Sometimes there'd be some funny words in there, and this is very fixed to certain languages, types. And we'd get a kind of an unusual score. But the deep learning method was able to generalize a lot better. And it's also going to allow us to move to a multilingual framework much more easily as well by using transfer learning or just taking advantage of some of the ways that you can train with deep learning. So here's an example output of what that would look like using our deep learning model. And an important thing is that now we're starting to get to a point where we can explain what the deep learning network is doing. You can visualize, by running through the activation of the nodes in the network and so on, but you can also just run different inputs and see what the score is, different sentences and so on, and try to explain like what sentences in this document were drivers for the score that it got. And I think that's very important to the people that use the data that we provide. So underlying technology, we use some of the common platforms and cloud providers. We did some tests with Google Cloud. We're running it with SageMaker right now, using Spacey and TensorFlow. So kind of typical, but I can't go into a lot of detail about this, but we did just present this at the open source conference, the OSCON conference in Portland a month ago. So I think you all have a Safari account based on this conference, so you can go and see the video, or there's slides that are downloadable as well online. So the next one is prediction of M&A, merger and acquisition activity. So for this project, we took a combination of structured data, like traditional M&A activity, pricing data, company financials. We combined that with patent data to understand peer activity and likely acquirers, and we combined it with text mining as well to create an overall prediction of merger and acquisition activity for a company. Right now, it can run on a daily basis, scoring 25,000 public companies using this as input. And we had to create very distinct models for different types of deals because there's a lot of reasons why you might get acquired. Maybe you're a strong value play and you've got really good financials, but you're undervalued. Maybe you're just a growth story and people want to grab on to that success. Or maybe, beyond value, maybe there's real distress there and it's really cheap and there's issues that an acquisition might be able to help with. So we had to, you can't train a model on all those at once, and we had to distinguish between some of those cases. So I'll leave it at that for that model too. I don't have a lot of time, but there is a webinar that we just did about a month ago that has information on this. If you Google M&A prediction Thomson Reuters, it has more information. And goes into some of the details about how we modeled that. So to kind of wrap up, I think some of the key points that we learned while doing this is that there are ways to make interpretable models. Customers are really starting to explore AI, and there's a lot of interest in alternative data and using AI for that purpose. We're investigating more into deep learning and how we can kind of reframe some of our older models and build new things with it, and that has a lot of interesting ramifications. One issue that's coming up more and more is around data provenance, and I think we get approached by alternative data providers all the time to redistribute their data. I'm sure every hedge fund or asset manager does as well. But I think companies aren't going to want to trade on data and then find out later that this data has insider information or was scraped illegally against terms of service agreements or whatever, and or came off people's phones and didn't account for privacy regulations. Especially with GDPR, there's a lot of risk there. It's kind of like we do a lot of third-party risk type of evaluation for supply chain, for manufacturers. And companies don't want to discover that there's slavery, forced labor in their supply chain, or bribery and corruption. And there's even regulation now to make sure that you're doing some due diligence along those lines. So I think that's going to come into this whole use of data as well in your modeling process and what you trade on. More and more focus on alternative data as companies discover that they have value in their data and their data exhaust and maybe can monetize that or use it internally. I think companies are discovering that the best type of alternative data is the data that they have themselves, because then nobody else has it. And if they can take advantage of that, then that's great. And then we're also working on building an accelerator type of thing for data science, basically like a workbench that you can use to quickly get data in a cloud framework, not have to create this big infrastructure yourself, and download or work with Python, Jupyter notebooks to quickly kind of go through and work with that. So we're trying to be very developer friendly. So that's it. Any questions? Yep.
So were you trying, instead of using default labels, which are basically, as I said, trying to use risk for predicting default, where did you get the risk scores for those?
So for the original model, we trained on the actual credit event, and then that model produced a probability of default. And so since that's been running now for quite a long time, and we have historical data, simulated data from that as well, we used the actual probability of default from the original model to train our deep learning model, which sounds kind of counterintuitive because you want to kind of leapfrog it, but it was interesting that it seemed to work and generalize better and stuff. Yeah. Oh.
Either or. Sorry, my question is going to be pretty quick. It's about your data sources. So it looks like you're using like images, text data. I'm just curious, as of right now, what other potential data sources are you working with and you think would have a lot of potential to help with some of the products that you're building out?
Yeah. So, I mean, from an alternative data standpoint, there's a lot of interesting things. I mean, we're talking to providers that put sensors on cars and can track cars. And, sometimes I think that the satellite imagery is going to kind of go away in importance if we have sensors on everything and can tell where everything is to begin with. So, you might even be able to use more of that data about a car to see, for example, in a parking lot at a store, was the trunk opened? Because that means they actually bought something. Mm-hmm. So, all different types of data from alternative data providers and from companies that are interested in monetizing. And we're also trying to look more internally. We have a lot of text data, a lot of different things that we can try to leverage. We have a lot of transactional data that can tell us a lot about the market and about flows and, behavior of investors and so on.
Thanks.
Yep.
Okay, so the question I have is regarding the SEC data. And do you process that and understanding particularly the fine prints at the bottom, particularly in 10K, that is very tricky to understand because the way they do the reporting.
Mm-hmm. Yeah, so we have a pretty big content team that works through that kind of data. All the filings, we have some automated stuff to help with that workflow, but we also have humans in the loop to kind of assure quality. And I think more and more we're going to get pulled in to help apply AI to that, to kind of assist and speed up that process.
So related to that, so when you do the predictions or anything, so any compliance regulations you need to follow, some things that you can or you cannot do?
I'm sure there are. I mean, I think that one thing is that we're not an advisor. We're not an investment advisor, or we're not providing, investment advice to people. So that puts us on a little bit of a different regulatory standpoint and changes who our regulator is in a way. But our companies are very interested, as I said, in provenance, understanding in detail how the model was built and so on. So when we launch a new model, at least from our, on our quant modeling side, we do a very detailed white paper, and we kind of reveal everything about the model and how it works and so on. So a lot of these companies can recreate themselves if they wanted to, based on all the information we're providing. But yeah, I don't know if that helps.
Have you worked on any use cases for longer term, like bonds investments?
I don't know about longer term. We've done some projects recently around trying to predict liquidity, trying to predict spreads of the bonds, and predict pricing based on different curves. So I guess we have done some yield curve predictions. And that's kind of an interesting area because the data is a little bit more sparse than publicly traded equities, for example. Anything else? Okay, great. Thanks a lot.